Chris Weston and IG in Melbourne. Chris, our backdrop to all the European, I suppose, commotion right now is that the IMF doesn't think that Spain's commitments and France's commitments on austerity mean much at all. So all the talk that we're currently sort of preoccupied with at the moment, what good is it going to bring about?
Well, I don't think anyone believed it, to be honest, Carson. You know, Spain came out the other day with their reforms, their new budget proposal, which, yeah, the market initially cheered, but I think that the growth projections that they've based that budget on was that they were going to see a contraction in their economy of 0.5%. Yeah, I think the consensus in the market was for a contraction next year of 1.5% to perhaps even 2%. The IMF have come out and said Spain's growth next year, or contraction next year, will be 1.3%. So clearly, even the IMF don't believe that they're going to meet their budget targets at the moment. Now, I think the interesting side of things is that Mr. Schäuble, the German finance minister, has been saying, you know, push away from requesting assistance, Spain. You don't need it. The bond market will rejoice at your reforms because they believe that you're going to get those growth targets. Well, the bond market doesn't buy it for 1 second. They don't believe they're going to get to those targets. So the fact is, Spain are pushing away from requesting assistance. The market and all risk assets wants to see them request assistance. But clearly, at the same time, whilst a lot of European officials on the more conservative side are saying Spain's done enough, no one actually believes that they've done enough right now, and the fiscal targets that they've been setting for their economy are not achievable in any shape or form. So, yeah, I think what we saw last night was a situation, one where the market was, or risk assets such as US equities, euro, dollar, and other bits and pieces were catching up to what we've been seeing from, for example, the Dow Transports, where that's been more, a closer reflection of the US and global economy, with what we've seen with UPS and FedEx, etc. And that big diversion we've seen from the Dow the Dow Industrials, which is what obviously everyone quotes because of the stimulus that's been put through there. So I think last night we saw markets and risk assets playing catch up to the global growth story, and I think the IMF and their growth forecast probably gave people that chance to really reflect that, and that's why we saw them down. Because the comments from Schäuble that came out last night that the ESM are not going to buy legacy assets, that was all known. It gave the euro a bit of a push down. I think euro fell because of some issues with a potential change to the Bloomberg Spanish 10-year benchmark, but I won't go into too much details about that. But a lot of what we saw was
the yields went
a lot of what we saw was pretty much known. But I think really deep down, I think it's just the markets are playing up a bit of catch up with the global growth forecasts. There's a pretty good chance we're probably going to get them revised again by.
That's a bizarre thing, yeah. But Chris, just on that very point, without glossing over it, because markets playing catch up to global growth forecasts. Hang on, IMF and World Bank were meant to be late to this story. What are you now saying that the markets are playing catch up to them?
No, I think the markets I've been saying for a while, I think that the equity markets have been very, very tired. Now, what I mean by playing catch-up is that the IMF have been playing catch-up to where most investment banks have been. I mean, if you look at global growth, being taken down to 3.3%, that was expected. The Australian growth forecasts for next year are pretty much in line with where the consensus on Bloomberg's been sitting for a month or so. So the IMF agreed are playing catch-up. What I'm saying here is that there's been so much stimulus being pumped into markets from all walks of central bank life that I think we're seeing a situation where, as I say, the Dow Transports and the Dow Industrials have diverged because the S&P, the Dow, hasn't actually shown a clear reflection of economic performance and have been propped up by stimulus. And perhaps it's just giving people a chance to reflect on the real economics as opposed to purely stimulus there.
Chris Weston, we've just got to hold you there for a moment. I know you're going to hang around. Thank you for that from IG. We do have some other news to cover just in the next few moments. This is the latest read on consumer sentiment just out a very short time ago. Seems to be some red flags in there, particularly when you consider the rate cut that was delivered just a week ago.
Well, indeed. Let's just kind of run you through some of the highlights. We're out at an 8-month high, so that's the bigger picture story. But going below that 100-point mark, still below that essentially, so more pessimists as opposed to optimists. Westpac's chief economist Bill Evans calling this read disappointing, and he's now at the Westpac camera for us in Sydney. Bill, great to have your company. You know, we are base building, though, are we not? OK, we may not have hit that magic 100 mark, but, you know, are you surprised, given the whole growth profile that we're talking about, not just here but offshore, that people feel the way they feel?
Yes, Carsten, I was expecting a much better result today, given that we had the rate cut from the RBA that was not expected, so it would have come as a very pleasant surprise to a lot of mortgage borrowers. We had the announcement that the unemployment rate had come down from 5.2 to 5.1, and of course we've had all the news on on the stimulus packages, which has led to a 4% jump in the share market. And yet we've still got more pessimists than optimists. And this is the 8th month in a row. And of the last 16 months, we've had 14 months where we've had more pessimists than optimists. And we really have to, the only time that's been comparable to this is obviously during the global financial crisis, when we had 16 months where the pessimists outnumbered the optimists, but only 16. So we're now up to that magic 16 number again.
That means a 2009 style recovery looks decidedly unlikely this time around. Explain that to us.
Well, yes. The 17th month in that last period, sentiment started to move pretty quickly, and over the next 4 or 5 months it jumped by 30%, got up to a level of 120 from a level of 90. And there were a lot of things that were pushing that level of optimism, particularly fiscal policy. The economy was benefiting from a fiscal stimulus to the tune of about 6% of GDP over 2 years. We remember all of those initiatives, the money for the $800, the building education revolution, the first home buyers grants, etc. None of that's happening now, of course. We've got fiscal policy tightening. Had a much bigger rate cut last time. It fell from 7.25 to 3. And of course we had a much bigger globally coordinated stimulus. This time the large governments, with the exception of China, basically haven't got anything more that they can do apart from QE. And of course we are very much waiting for China to do something that will certainly help Australia.
Bill, if you kind of move outside the mortgage belt and you look at the way rate cuts hit the real economy, those in that 20 to 40,000 household income bracket, there's been a massive fall in confidence there off the back of these cuts. It would suggest that it's a kind of a Main Street doesn't touch us story.
Yes, well, I think people are concerned about their jobs. I think that's the critical thing at the moment, and it was so refreshing to have the Reserve Bank give weakness in the labour market as one of the reasons for the rate cut last week, and even more refreshing to read the paper that the Reserve Bank Deputy Governor gave yesterday, where he really did qualify the fall in the unemployment rate. That's the centre of things at the moment. But how do we get the labour market moving again? It's usually through these interest rate sensitive parts of the economy. It's housing, it's consumer, etc. Because we can't rely upon the mining boom. Mining has added 300, mining employment has picked up from 100,000 to 300,000, but we are now starting to look over that peak. And mining investment is going to slow from 2014, and so the boost to employment will really only last next year, and we need to see these interest rate sensitive parts of the economy, construction, consumer spending, non-residential construction, start to fill that gap.
So why shouldn't the Reserve Bank deliver a supersized cut in November, 50 basis points?
Look, I think the risk of that is always that as rates get lower and lower, so the hurdle for a big rate cut becomes higher and higher. And with rates now at 3.25, likely to go to 3, I think the Reserve Bank will be thinking that our powder needs to be kept relatively dry. 1 month is nothing from the perspective of a central bank, so why not do a quarter, and then if we feel we need to do another one in December, that's not our forecast. Our forecast is the next one will be early next year. If we feel we need to do another one in December, we can certainly do that, and we can do more after that. Well, as you know, the market's predicting that rates will get down to 2.25.
Yeah, market always loves to, as you know, overshoot on either which direction. But would they be cautioned and concerned, Bill, finally, by the call from S&P just out today that WA's recorded the nation's highest level of arrears in the second quarter? If they were looking to bring growth about into states aside from the mining boom, that's a worrying signal if even the strongest of the strong are recording high arrears.
Yes, well, we talk about the two-speed economy. Well, Western Australia, of course, is a microcosm of that. There are many businesses in Western Australia that are not benefiting directly from the mining boom, and when I talk to my customers over there, they say that the spending that should be resulting from the income boosts that we're seeing is just not coming through. So a lot of sectors of that Western Australian economy that continue to suffer.
Bill Evans, thank you so much. We will let you go. We appreciate your time as always after the release of the survey. Thanks.
Thank you very much.
Thank you, Bill Evans, Chief Economist of Westpac. And as promised, we've also kept Chris Weston on the line there from IG, I understand, from Melbourne. Chris, thank you so much for just waiting on. Just getting back to the overall market, we've talked kind of macro and global, and I suppose there's some commentary coming in there from Bill Evans. Any thoughts on that survey and what it's reflecting kind of locally about these issues that we're talking about, I suppose, on Business Channel on a day-to-day basis?
Well, I guess you know, the consumer's still not. I mean, I didn't actually hear the numbers, unfortunately, but you know, it didn't sound like they were too flash. You know, I think we're going to have to see interest rates being slashed dramatically, and I think what's going to probably be the interesting dynamic that if we do see rates coming down to 2.5%. I personally don't see 2.25%, as Carson rightly pointed out. These markets, the IS market, the credit markets, have a tendency to overshoot. I think if we get down to those kind of 2.5% levels, you know, I think the RBA will be keen to see exactly what happens with discretionary spend, because people obviously be looking at the equity in their houses, those kind of bits and pieces, and they'll say to themselves, right, this is the time we can use some of that to leverage out, buy holidays, some of the discretionary purchases. And I think perhaps as well, if we start seeing a market improvement in the equity market as well, that could be another situation that boosts confidence going into the back end of the year. Do I think that's going to happen? I think there are some major risks that we're facing at the moment. For example, Goldman Sachs is seeing a 13-14% pullback in the S&P going into the end of the year because of the fiscal cliff issues. That could obviously have big reverberations on our market as well. So I think, you know, if housing pushes up a little bit stronger, and obviously if the equity market continues these inflows that we're seeing, not just from domestic traders and domestic investors, but also I think we're clearly seeing foreign money into our market, you know, that could boost investor confidence going and consumer confidence going into the back end of the year as well.
So many ifs in that, but of course, you know, the unexpected will always happen. Just in terms of China today, just a kind of a world away from what we're discussing, but the pop from yesterday, Chris, you know, your response to that one, likely to continue, or perhaps that was just as good as it got?
I think what we're seeing at the moment, Carson, is just a really, really interesting dynamic coming out of not just China, but also from the Asian region. Yeah, first of all, let's point out exactly what's going on in the emerging market side of things. I mean, Korea last week had a much better than expected export number. Taiwan yesterday, their exports up 10.4%. That was much better than expected. Now, if you get those two markets together, if you get those two economies, they are seen as very much a leading indicator. They report their export figures a lot earlier, and if you actually look at a chart, they generally lead global export growth by 1 or 2 months. It's a really strange dynamic because obviously they're very export-sensitive economies. There's a lot of people I've been talking to starting to warm to the Australian dollar, warm to that side of things because of the big pickup we've seen in that, and perhaps that could lead that Chinese exports could have seen a bottom, see a bit of a pickup. Of course, we can look at the Macau gaming revenues in September, up 12% or so after single-digit increases in recent months. Again, that's got a strong correlation with Chinese growth. And I think we're at a very interesting situation. I mean, obviously people were pointing out not just the Shanghai Composite. You can have a look at some of the domestic other indices. You can look at the Hang Seng. Another one we're looking at is the Hang Seng China Enterprise Index, which is a really interesting index. These are stocks which are traded or listed in China under the Shanghai Composite. Obviously, foreigners can't invest or trade in the Shanghai Composite. That's purely a retail, well, mainly a retail-driven Chinese market going there at the moment. But the enterprise index is stocks that are also listed on the Hang Seng, which anyone can trade, anyone can invest in, and therefore, to me, a really good barometer of what people are thinking of Chinese companies. Now, these are actual companies that are packaged together under this index. Now, that's had a really strong breakout. As we talked about, the Shanghai Composites had a big breakout of the April downtrend as well, which is great to see. But I think really the big driver yesterday was the big liquidity that's been poured into their market. $42 billion being poured in of liquidity being injected by the PBOC into their money markets. This is kind of seen as a bit of a watered-down way of doing a reserve ratio cut. It seems that that's kind of taken that off the table a little bit. But there's also other situations which are really interesting. We know the handover is now taking place on November the 9th, given some sort of certainty to the market. But also there's talk that perhaps some of the state-owned enterprise investment groups are being pressured by certain investment, by the powers that be to start investing more heavily in Chinese stocks as well. And I think that's part of the reason we saw some massive volume going through those markets yesterday. So we're hoping that side of things is going to continue to improve. I certainly, in terms of the currency markets, I wouldn't be running short Aussie dollar positions against euro and sterling now. I'll be closing those out. I think they're really interesting dynamics, both from the export numbers I talked about there, but also if we see a material pickup because of the investment that's going into these companies, then the Aussie dollar could be supported, and we saw rock solid support over the last couple of days at 101.50 on the Aussie dollar against the greenback as well.
Yeah, well, we just have seen slippage since down to the 101.90. So yeah, above those levels, but yeah, our consumer confidence print took a little bit of a bid further out of the local unit. Chris, thank you so much.
Cheers.
Quick break here on Trading Day. When we come back, looking at the corporate bond market in the wake of the oversubscribed BHP offer just yesterday.
Yeah, and pondering as well just what the start of US reporting season means for you and your investments. Find out when we come back.